How do you avoid margin call issues in commodity trading? Imagine watching your trades closely, knowing that a sudden market move could wipe out your account if you're not careful. That's what avoiding margin calls is all about. When trading commodities, it's vital to keep your account safe from unexpected drops in value. A margin call happens when your account falls below the minimum amount of equity required by your broker or exchange. This can happen if the market moves against your position, causing losses that eat into your margin. To stay ahead, you need to manage your risk well and keep enough funds in your account. One of the best ways to avoid margin calls is to always keep a buffer of extra funds in your margin account. Think of it as a safety net that absorbs market swings. If you only meet the minimum margin, even small adverse moves can trigger a call. So, adding a cushion of at least 20% above the minimum margin can give you breathing room. Next, avoid using too much leverage. High leverage means you're borrowing a lot to trade bigger positions. While it can amplify gains, it also magnifies losses. Using moderate leverage keeps your risk manageable. For example, trading with a leverage ratio of 2-to-1 or 3-to-1 is safer than going 4-10-to-1 or higher. Regularly monitoring your trades is also key. Keep an eye on your open positions and market news. If prices start moving against you, act early. You can close or adjust positions before losses become too large. Setting up alerts for price levels can help you stay informed without constantly watching the screen. Using stop-loss orders is another smart move. These are automatic instructions to close a trade if it hits a certain loss point. For instance, if you buy a commodity at $50 and set a stop-loss at $45, your position will close if the price drops to that level. This limits your downside and helps prevent your account from falling below the margin requirement. Diversification also plays a role. Don't put all your money into one commodity. Spread your investments across different markets. If one moves sharply, it won't wipe out your entire account. Having enough liquidity ready is important too. Keep some cash aside to meet margin calls if needed. When markets are volatile, quick access to funds can prevent forced liquidation at unfavorable prices. It's essential to understand the margin rules for each commodity and exchange you trade on. Different contracts have different initial and maintenance margin levels. Knowing these helps you plan your trades better. For example, if the initial margin for a crude oil contract is $5,000 and the maintenance margin is for $1,000, you need to stay above that threshold to avoid a margin call. Avoid holding positions during times of high volatility, like economic reports or geopolitical events. These periods can cause sudden price swings. Reducing your exposure or hedging your trades during these times can lower your risk of margin calls. Finally, use analysis tools to anticipate market moves. Technical charts and fundamental data can help you see potential risks early. Risk management software can simulate scenarios, showing how different market conditions might impact your margin. By following these steps, you can keep your trading safer and avoid the stress of margin calls. Proper risk management, careful monitoring, and strategic planning are your best tools to stay in control and protect your capital in commodity trading.